Right. So, very good morning to you again. And the topic that we shall be studying today together is the major global corporate scandals, the scams, whatever you call them. But they are the ones who are very impactful, and it's like a collapsation of an empire. It's not that when a company fails, that is the only thing happening. No, when there is a corporate failure, then many people become unemployed. People lose trust in the modern corporate world. All those skeptics, all those naysayers, they come forward, and then we start questioning ourselves. Well, it's not a bad idea to question ourselves, but at the same time, losing trust, losing faith, and losing hope is something which can have very dire consequences. Uh, it's like we still remember the World War One, we still remember World War Two, we still remember all those major catastrophes the world has experienced, even though they have bygone since decades or maybe almost a century. The same thing happens when there is a corporate failure. The world has seen, and by the way, the corporate failure is a very natural phenomenon. It's like the human being dying, basically. Companies also die, but the way the companies die is very important. The companies, if they are taken over, if there are mergers, if there are some kind of acquisitions, if there is restructuring, that is understandable. That's more natural demise. But if a well-functioning company, supposedly well-functioning company, uh, suddenly, without giving too many signals, wither away from the global scene, it just collapses. It just gets finished in a span of few days or few weeks, and then when you do the what I'm doing, and when you start making the investigation, you find out that there was a very strong human errors, greed, selfishness, lack of empathy. They were the prime factors behind the cause of death. And all these bad things were practiced by those people who were supposed to be the custodians of the company, who were getting millions of dollars and euros to take care of the company, but they did the opposite. Then you start losing the faith, and it's more like a backstabbing. It's more like you don't fulfill the commitment. It's like a breach of trust, as I mentioned a few times. So today we shall study this little bit. I have 4 examples, but those 4 examples, believe me, they still exist. Their relevance, their vitality, their importance still exist in the more even now. Okay, so this is a little bit of backdrop of this topic. Okay. And in between, if you have any questions, comments, let me know, and I will take a pause from the recording and I'll explain it to you. So we understand the major corporate scandals and their consequences. We are hoping to study the effects of these collapsations on different stakeholders, and have we learned any lesson from these scandals? Enron is the first one. Enron was first one. Enron has shaken the world. If I have to compare Enron with some political big, the events, I would Enron in as an example in the corporate sector, as I can give the example of World War II or One on the political spectrum. This was such a massive. This was the first example in the modern world which shook the faith of people, a common man in the modern day of market-driven economy. Enron was world's leading energy, commodity, and services company. It marketed natural gas, delivered energy, and the physical commodity. It was one of the most respected company, so much so that a year before its death, this company was given the most, the corporate social responsibility award as well. So much was this company reputed. Its revenue in 2000, I'm talking about 25 years ago, quarter century ago, that time its revenue was $100 billion a year. It was fifth largest company in the Fortune 500 and employed 19,000 employees, plus employees in its subsidiaries all over the world. It has operations in many countries. One day, on 2nd of December 2001, the company filed an application with the bankruptcy procedure that, sorry, we want to be bankrupt. Enron followed a hyper aggressive growth strategy. This company, this example of failure, corporate failure, if I have to underline one major reason why this company got bankrupt, it was its hyper aggressiveness. The company, the CEO, they were behaving like some, the old historic characters who wanted to conquer the world. So these people who were leading the team, they didn't realize the limitations. So one lesson I learned from this failure is that growth is not bad. We all want to grow, but we also have to be realistic that to what extent the growth is sustainable. Can we sustain the growth? An athlete who is a 100-meter runner, maybe one day, maybe one off, he can participate in 800-meter or maybe 5,000-meter race, but can he do it every time? Has he got training to run a long-distance race? The same thing happens in this case. You can artificially engineer growth of the company once, maybe twice, but can you do it forever? Can you do it sustainably? No. If you can't do it, then you feel the pressure to make it happen. And in this pressure, you end up doing something. These people, they ended up doing something very stupid. And I'll tell you what they did. And these were the people who were not common man in the street. They were highly educated, highly experienced, very well politically connected. I mean, they are the people who was running this company who would play golf with American president and those all big wigs. And they were so close. And then what happened? Enron followed a hyper-aggressive growth strategy. Enron moved from the energy production and distribution company to more diversified portfolio. The company thought that, oh, we are successful in energy production. We are successful in energy distribution. So now we have this, what is a phenomenon called Midas touch. You know that? Is it Midas touch? That you touch something, it will turn gold. And then they entered in those fields which were not even in their area of specialization. For example, financial services and broadband. You can't do anything and everything. It's very important that we recognize a company and also a human being. We identify what qualities we have. So let's remain in our comfort zone or our specialization zone and excel in that, and only move to another field, another domain, if we have got training, if we are very confident that we can do it. Just because we are successful in X venture doesn't mean that we can be successful in Y venture as well. Okay. The company's management was overwhelmed. The problem is that there's a lot of behavior finance. Role is very important in the world of finance. What I want to say is that when you raise the hopes of your stakeholders, your investors, it's very difficult to bring it back, to mellow it down. This company, with its exponential growth, with its growth overnight, and the managerial attitude that they want to make an empire, it raised hopes uncontrolled, indisciplined hopes and expectations in the minds of particularly investors. So there was no stop now, because even slowdown would mean that investors would be very upset with the company. So that is why it's very important that when we want to raise hopes, we should go slow. The company raised hopes very fast, and when the company realized, oh, this path of growth is not sustainable, it was almost too late for the company, because you can't really dip down the hopes once you raise them too much. There were some warning signals given by some of the whistleblowers, the ex-employees, the analysts, before the actual problem. But unfortunately, those warning signals were ignored. Like the warning signals were given before 2007 crisis, like the warning signals were given before the COVID-19, but we ignore them sometimes, and then the result is obvious. Like the warning signals were given before the British Petroleum's Gulf of Mexico crisis. I told you that case in another topic. The most corruptive thing which Enron did is in this paragraph. Enron created some fake companies, and not one, not two, 700 fake companies. And they were named as special purpose entities. And these were under the flagship of Enron. The main company was Enron, and under its domain, they created 700 fake companies. The reason was that the company was borrowing too much at that time. When you borrow too much and you show your borrowings in your consolidated balance sheet, everybody can see it. I hope you all know what is consolidated balance sheet. You have seen, right? The financial statements of the company. So when you borrow too much, obviously you will show them here. In your current debt, and also in your non-current debt, the finance debt, the lease liabilities. Is any way that you borrow and don't show? So that even if you're borrowing, your company is neck deep in debt, but nobody's noticing what you're doing. Well, Enron had a formula, and they created the private companies, because for the private entities, you are not supposed to show the data to public. And the company started borrowing in the name of these 700 fake companies. So company was borrowing, the money was coming to Enron, but it was not shown in the Enron's account, because when it was going to sign the documents from bank, they would put forward not Enron, but these fake companies, official, so that you borrow and it doesn't show in the records. And the money was ultimately coming to Enron. But after all, how long you can do it? At some stage, the lender would ask the money back. Then can you run away? No, you can't run away. And then suddenly this picture revealed that, oh, no, that was just a facade. That was just a kind of fake thing. The actual borrower was Enron. The analyst found it. The financial media, they found it. And some of the company's executive, they also, they went to the regulator and they complained that, you know what, all these so-called SPEs, like marketing company, debt company, they all are fake. They all are just fake. Nothing more than a name, that's it. The money is borrowed by Enron. And as I said, that the money was borrowed in the name of these special purpose entities. Therefore, a lot of liabilities were off the balance sheet, which means that they were not shown in the balance sheet because you are borrowing not in the name of the company, main company, but it's special purpose entities. And as a result, when you are not borrowing officially, you're not showing, you are not even showing. If you don't show your borrowings, you will not show what? You will not show your finance cost. And when your costs are downplayed, underestimated, then your profit is more. So Enron was trying to kill two birds with one stone. On the one hand, it was underestimating its liabilities. On the other hand, it was exaggerating its profits. And that's what the investors want. As an investor, I would love that company which has a bright future. The company is doing a good job. But on top of that, the company's liabilities are less and the company's net profit is more, because net profit means the company will give more dividend to me. So I would appreciate, and that's what the company was doing. Okay, but there was no cash. The profit was very high, but there was no cash. So you need to understand that cash and profit are two different things. So that is why the company had inflated profits. According to the agency theory, which we discussed some time ago, do you remember that the company's shareholders, the owners, they are called principal, and those who are running the show, the managers, they are called the agent. Ideally, the principal and the agent should have a very cohesive motivation. But the problem occurs when the principal are demanding something else and the agents are going in a different direction. This company is a classic example of agency cost, when there was a massive divergence between expectations of the shareholders and the managers. According to the agency theory, one cost was monitoring cost. You remember I showed you three components of cost of agency, the monitoring cost, the bonding cost, and the third one, the residual loss, means the superpower which the managers always have. The monitoring has to be impartial. The monitoring has to be objective. The monitoring has to be in depth. But in case of Enron, the so-called independent auditor or the external auditors, his name was Arthur Andersen. It was also doing the consultancy business of the company. On the one hand, it was monitoring the companies that are their accounts truthful, are they giving proper information? But on the other hand, the same company, Arthur Andersen, was also advising the company how to cheat, how to avoid tax, how to borrow money through, by the way, this idea of special purpose entities was also given by Arthur Andersen, that why don't borrow in your name, create some fake companies, not even 700, and borrow against them and don't show in the records. And then the same Arthur Andersen is giving a signature. Yes, all the data provided by Enron is true and objective. So it's like a cop. It's like a cop who gives you a hint that tonight we will not raid before midnight. So if you want to commit any crime, you want to rob people, you want to, kidnap, do it, but do it before midnight, because after midnight we will come and start, checking the, inspector. So the same thing. So it was giving the same thing. It was playing both the good cop, bad cop role. So the same company, Arthur Andersen, who is supposed to check that the company's financial data is true, objective, comprehensive, was also telling the company how to cheat. And when the company cheat, they would approve it. Yes, good job done. And why would they do it? Because they were getting $52 million just before, because the company had disappeared in 2001. In 2000, year 2000, they got $52 million from Enron. And guess what? 75% of this money, which Arthur Andersen received for its services, they were non-audit services, which means it was more coming from consultancy business that they were giving to Enron, which means that it's a classic case of conflict of interest. Yeah. So obviously, when Arthur Andersen was heavily dependent on Enron, on its one client, why will not they advise them how to cheat? Because out of this money, only 25% was coming from the main business, which is the auditing. The rest 75% was coming from non-auditing business, which is technically guiding the company how to cheat. Because of this too much of these things, these bad things, eventually Enron lost huge money. And now the Financial and Security Board, just FSC, Financial Accounting Standard Boards, which is in the US, I created new roles that how much you can do non-consultancy business. But anyway, it's too late now. When Enron's cheating was caught, same time, Arthur Andersen's cheating was caught as well. And then eventually the Arthur Andersen also shut down its business. So when this Enron happened the same day, the same time, Arthur Andersen also disappeared from the scene. So as I wrote here, Arthur Andersen vanished too. So obviously nobody would trust this type of auditing company. In 99, in 2000, why I'm telling you these things? Because this predatory behavior of some companies, it hasn't disappeared yet. There was a guy called Arthur Levitt, and nothing to do with Arthur Andersen. He was the head of the Securities and Exchange Commission of the US, which is a top regulator. And the idea was that he was contesting that, guys, he was addressing a meeting of auditors. And he was telling, guys, I know you are under market pressure to raise revenue, but please don't do too much of consultancy business because people will start suspecting your objectivity and your impartiality. And then the CPA firms, they gave a counter argument to Arthur Levitt. They said, no, I think, Mr. Levitt, you have some misunderstanding about us. In fact, more consultancy we do to a firm, more we know about it, and more we can check if the data they're providing is true or fake. So it means that before the actual scandal, the regulator, under the leadership of Arthur Levitt, they were trying to convince these auditing companies, guys, behave yourself. But they were given a counter argument by the companies that no, let us please allow us to continue. We want to do more consultancy business because then we are in a better position to know the truth of the company. But it was not true. Now, after 2000, in 2002, there was a very famous act called Sarbanes-Oxley, we call it SOX, was passed, in which there's a limit that what percentage of revenue of a CPA means the auditing company, can come from the non-audit services. I think that if I'm not wrong, now the limit is 5%. 5% means if you are an auditor of a company, if you get $100 for your services, maximum $5 you can get for the consultancy business. 95 has to be the main auditing business. But people devise different techniques, so it's not very effective. Yeah. The audit committee of Enron, they were not, in fact, the whole board of directors was misbehaving. They were not having time to even attend the board meetings of the company. They were taking success for granted. I think I told you once that the companies make the cardinal mistake when they are running, when they are at the peak of their success, and they take success for granted. They become complacent. They become slack. They become lazy. They feel that nobody can touch them. They're untouchable. They're too high, you know, to be touched. But that's where they make the gravest mistakes. Nobody was taking things seriously, including the chairman of the audit committee. He was a retired accounting professor from a top university of USA, but he didn't have time. And in fact, there were not many meetings of the auditing committee or the board of directors because they say, hey, why should we meet? Things are going so well. You know, committee meetings are a sign of discipline. I think I showed you once. I think I did actually. Um, if I search by meetings, there's so many. That, for example, in the context of British Petroleum, you can see the board meeting attendance. And the board meeting attendance is a sign of the company's leadership's commitment towards the company and the discipline. It's a sign of commitment and discipline. And you can see here that in case of British Petroleum, the board members in general are very disciplined, and there's almost 100% to 95% attendance. Well, can also be a sign of discipline and commitment in the studies as well. Okay, well, I will not say much about it. So in case of board of directors and the board committees, attendance is a sign of discipline and a sign of commitment. It shows that how committed are you to discuss, debate, contest, put forward your valuable viewpoint, and are you understanding the whole scenario in which company is working? Unfortunately, for British Petroleum, there were no real proper meetings even. As a matter of fact, Enron's management was doing so much on PR, the public relations, making very colored annual reports, so many pictures. If the annual report is of 200 pages, there are 50 pages of lovely pictures. They are making a lot of, the media appearances. The chairman, the CEO are appearing on page 3, meeting the bigwigs, attending those very popular movie and the music awards, sponsoring, in the company of top football players, in the company of top Hollywood actors and actresses, So they were more on the PR job than playing. I mean, they should be in the board of directors, but they would go and attend the Grammy Award instead. So these type of things are happening. So they were more laying emphasis on the media exercises. And they were very close to the both Republicans and Democrats. They were funding their campaigns. This party, this company is a typical example that they were funding the election campaigns of both major or the only two political parties in the US. And they were very close to the serving politicians and the retired politicians. What happened? What were the consequences? The consequence was that the executives, many of them appeared before the congressional events, the calling. They appeared before the Senate. They were questioned, and many of them were behind the bars as well. But did it serve the purpose? The Enron chairman, Kenneth Lay, he was the actually guy who was behind this whole fiasco. He took away about 123 million from the stock options in 2000 before. So he knew that he's in a sinking ship. The boat is sinking. So he made hay while the sun was shining before the ship sank. Do you know the meaning of options, the stock options? Hmm? He exercised the some million of stock option. The stock option is that, if I can quickly explain it to you, even though we will discuss more in some finance course, but I can quickly share with you that what is the option. Just a sec, I can explain it to you. The stock option is a pen? Text. Yeah, okay. The stock option is, imagine my salary or CEO salary is 10 million, and 80% is based on performance, which means 8 million is coming from the performance. And the performance is that the company asked me that we would give you a share which is worth $10. So I'm getting 8 million of my salary, performance-based pay, in the form of stocks, the shares, and the price of the share is $10 per share. It means if I divide 8 million by 10, I have the right, I have ownership over companies 800,000 shares. What I do, my only focus is to artificially push the price of the share up. I don't care about anything else. My only focus is to hide the bad news, release the fake good news, hide the liabilities, artificially engineer the profit up so that I send all the good vibes in the market. And when I send the good vibes in the market price will go up. Let's say from $10, I can get it for $10, but let's say the market price jumps to $70, because all the things which I've been doing, all the good things which I'm showing and all the bad things which I'm hiding. And guess what happens? I can buy a share from the company for $10. I have the right. In the market, the share price is 70. So I get a share for $10 from the company and I sell for $70 in the market. It means that my 8 millions actually become 8 times 7, 56 million. The company promised me that your 8 million will come from the stock, but I sell that stock in the market and I get 56 million instead of 8 million. This is called stock options. The idea behind the stock option is that we try to align, we try to create a bond between the company and the agent, the manager. But sometimes, because of the agency cost elements, these stock prices are inflated artificially, especially the Kenneth Lake he did the year before the actual death of the company, because he knew the reality. He knew that it's a good time to offload its options, its stake in the company, because the company is a sinking ship. It can die anytime. And before it sinks, before he gets arrested, before he's behind the bars, it's a good idea to have a lot of money. And that's what he did. So the price which he bought stock and the price which was market was giving, because of all the fake news he was creating, it was 7 times more, 7, 8 times more actually. And he sold his stocks expensive in the market and made money. Yeah. What happened to the investors? Well, they lost everything. Um, the companies just before the company got failed in December 2000 something, yeah. And the 2 months ago, the price was $90. And then after a few months, the price was $0 because the company became bankrupt. So, so the investors lost everything. Employees not only lost their job, but the company was also gambling with their pension funds. So when the company got bankrupt, not only the employees lost the job, but when they were questioned, hey, where is the pension fund of the employees? They said, oh, sorry, we just played with it. So much was the indiscipline, financial indiscipline, that nobody was knowing what company is doing. The creditors, many banks, many creditors, they got nothing from that. Competitors, this is a very typical, very unique story. Whenever a company loses, the other company gains. If the people don't buy Pepsi, maybe they will buy more Coke. If they will not buy something from X company, they will move to Y company. But in this case, the whole oil companies, the whole energy companies' name was so much tainted, so much dented, that people lost faith in the big companies. I think this was the classic U-turn when people in general started losing hopes and they start looking at these big companies as the predators that they are snatching, and all this afterwards is left liberal, whatever these philosophies, they became more popular in that time. Oh, we are losing faith in capitalism. Capitalism is bad. This is this, this is that, and all new school of thought. So that was a classic case when people started losing faith in the big companies. Yes, Siri? How big? No. Okay. They have new website, they have back here, they need to be more sustainable this time. They're like, or is it another Enron? I think it's something different, maybe, but it's not the same. It's maybe, yeah. Is it same? I haven't seen it. It's an energy company, a service company. Maybe it's, I tell you something, it could be possible that some part of this company has been acquired by some other company and they renamed it. I will check it. I haven't got, but this I'm talking about the actual Enron company in the 2000. Please check, is this web information when it was last updated? Really? Well, I have to check then, but certainly not the same company. 25. Oh, really? I'll check it and see. But I'm sure this is not the same one. It can't be. Investors lost. And then also the auditors, as I said, that the Arthur Anderson also. I have so much of text because I want that it should look like mini notes. So I didn't put the bullet points because that doesn't serve any purpose. Arthur Anderson, the auditing company, people also started losing faith in the so-called impartial third-party external auditors. It's like you watch football match and you not only doubt that some football players, they are cheating, but you also are doubtful that even the referee is biased, even the jury is biased. What will happen then? You will stop faith in the game. Maybe next time you will not watch football match. Same thing happened here. So the investors, the common people, the stakeholders, they started losing faith. Auditors who are the like umpires or referees. And as I said before, that because this auditing company was hand in glove with Enron, and when Enron failed, Arthur Anderson also failed, and this company lost its employees all over the world. They had the audit partner 85,000 across the world, and all of them, they have to change their labels. And some other, and the government bodies. So you can read them. You'll find that almost all the stakeholders in the world, in the US, they basically were the software. This was a case of Enron. Any questions about Enron? Yeah. All right. The classic example of Enron. And the second one is the WorldCom. Uh, the WorldCom was another telecom company in the US which got bankrupt. If you look at 2000 and 2002, you will see the hundreds of companies, big and small, they became bankrupt. There was a series of corporate bankruptcies. Every day, some big name was getting bankrupt, or at least alleged to do some corruptive practices. And the reason was that there was an absolute failure of internal control, corporate governance, and individual responsibility. The control system within the company was coming proper, ineffective. The whole corporate governance system in which the market, the investors, the regulators, the banks, the state, the board of directors, the audit committee, the executive directors, the non-executive directors, have the whole governance of the companies as if there's a full anarchy. There was complete failure of the system during those couple of years. And of course, the individual greed and shying away from your responsibilities and your personal greed overpowering your commitment towards your job, which you're not doing free, by the way, you're getting a lot of money in the first place. On July 2000, in 2002, the WorldCom Group was with more than 30 billion in revenue, a lot of employees. They filed a bankruptcy application again in the US. It was found out that the WorldCom has overstated its revenue, its profit, pre-tax revenue. What is pre-tax? Before tax, the profit before tax. Sorry, something stupid. Anyways, yeah. Between 99 and 2000, the WorldCom has overstated its pre-tax income by 7 billion. It was a deliberate, it was not an innocent calculation error. It was a premeditated calculation done to dodge the investors. 7 billion can't be a calculation error, right? Remember, we make two types of errors. Error of omission and error of commission. Omission is that, not emission, but omission. Omission. Oh, am I? The omission is when you omit something. Omit something. Omit means you can innocently forget to do the recording of some transaction, or you deliberately not record things which will create your accountability and responsibility. You say, oh, sorry, I forgot. Oh, well, Shab is saying, where is your assignment? Oh, Shab, I forgot the deadline. This is the error of omission. The one is error of commission. Commission is that you deliberately commit something to dodge the rules, to dodge the law, to dodge the practices. The companies, what I'm saying, they did both error of omission and error of commission. Omit, you forgot. Commit, you do something deliberate. The company subsequently wrote down its reported assets. Have you heard the word writing down of assets? Writing down of assets? Have you heard the word depreciation? Have you heard the word depreciation? What is depreciation? Any ideas of depreciation? The depreciation is that when you buy, let's say, a car, the accounting rule is that every expense should match the revenue. There should not be a mismatch between the revenue and expense. If you are getting the revenue of some asset for many, many years, then expense should also spread to the many years. Imagine you have a company car, you buy it for 40,000 euros today, and you expense it. It's a mistake. You know why? Because this company car is not going to be used only for 1 year. There must be some minimum working life of the car. Let's say 5 years. So 40,000 divided by 5 is 8,000. So you will not show 40,000 as an expense today, but you will show 8,000 as an expense. So that 8 plus 8 plus 8 plus 8 and 8. By the end of 5th year, when the company's car's book value is 0, all the expenses have been, taken into account. But you can't do this thing to wage. If I pay you wage, I can't spread your wage to 5 years, because wage is that I'm getting the benefit of the payment right now. So it means it should be expensed at the same time. The company was showing too much of profit. And the one reason was that they were showing huge amount of depreciation. They depreciated 75% of their total assets in a few years. And when you show more depreciation, what would happen? Your profits will go down. And which profits? The reported profits. And when you show less profits, you pay less taxes. That is what the company was doing. The company's history, they started with a small regional IT company. They were selling their the broadband to many small companies also. So if you are interested in reading the history of the company, this slide will help you. They were part of AT&T, which was a very famous IT company then. It was providing services to the small regional companies in the US. And they were selling some long distance discount services. They were selling it on discount, and they became very popular in no time. Bernard Ebbers, like we had Kenneth Lay in Enron, Bernard Ebbers, who was a co-founder and a CEO of the company, he was the man behind the downfall of WorldCom. The company grew rapidly, and their mantra was this: like Enron's mantra was to borrow money against fake names, LDDS was basically the WorldCom, technically, because they renamed it. In the beginning, its name was LDDS, but later on they called it WorldCom. They named it WorldCom. And WorldCom's mantra was to acquire, very predatory. Wherever you find some small IT company, go and buy it, so that the company is nearly a monopolist in the region. Okay, so their mantra, their business model was acquisitions. And they even acquired the companies in Europe and Latin America, for 1 decade. They started the company with this much money, which is very small amount, but soon this money was reaching to 1.5 million. And then the debt was financing their growth. So whenever they want to buy a company, they would pay not with the equity, but by the debt. So the company's debt, like in Enron, was also increasing. This company became public in '89, and uh, it was recorded, registered with NASDAQ. And then in '95, they, in a board meeting, they renamed the company as WorldCom. So in '95, they called it WorldCom, and then this company was part of NASDAQ. It became a listed company. And the corporate culture was characterized by the inept accounting system. The company will not even maintain the record of the company that it is acquiring. So there was no data, no records. The whole organization was scattered. The finance department was in Mississippi, the human resources in Florida, the legal department in Washington, D.C., and each of their department or a wing had their own style of working because they were led by some the area headquarters, and their functioning style was different from each other, and there was no real corporate culture. The culture has to be it can have the culture can have many nuances, but there should be some uniformity in the corporate culture. You can't do one thing differently and the other thing differently. Airbus was behaving like the emperor, and the reward system was very much decided by Airbus, that who to give promotion, who to give the bonuses, and who to even demote, and who should be in what position. That was almost exclusively decided by Airbus. And the people who are working in the finance, accounting, and investor relations, they were the darlings of Airbus because they were the people who were once again or in touch or in close, what is the word? They were having collusion with Airbus because they were the one who were playing with the data as per the CEO, Mr. Airbus' wishes. So some people, they were very junior, and suddenly they were given promotions, and their salaries were raised all of a sudden. The expense to revenue ratio, the company was expanding. The company was expensing a lot of money. They were spending a lot of money, and in one of his statements, Eber said that our goal is not to capture the market share or become global. Our goal is to become number one in Wall Street. We just don't want to be any global company. We want to be the number one in Wall Street. So that shows that it was a hyper growth syndrome, I can say, cynicism. When you become successful and when you are big and successful and rich, and your success is coming in leaps and bounds, it sometimes affects the people's psyche as well. The company was going for more and more revenue. They were even spending any amount of money to get the profits, to get the revenue. Unfortunately, 2000 was a decade because the telecom, the IT industry saw its heydays during 1990s. 2000 was a decade when the telecom IT companies, many of hundreds of companies in Britain, in the US, they just disappeared. 2000 was a year when the growth was slowing down and the telecom industry was also slowing down. Many new competitors came, and WorldCom has to cut down its. It used to be a monopolist, was dictating terms, calling shots, but now in 2000, WorldCom has to be more disciplined, more tamed. It has to cut down its prices because many new competitors came in the picture. And as a result, it was in trouble. They were using a huge amount of accrual accounts. Accruals. Have you heard the word accruals before? Haven't you? Hmm? If I say that we used this word last week, will you believe me or not? And not only I use this word, but we did some work on it as well. Rent accrued but not paid. Wages accrue, not given. Cash paid or not paid doesn't matter. If rent belongs to this month, it has to be recorded in this month. That is called accrual. The company was also using accruals extensively. Accruals means it was recognizing the revenue which didn't even mature by using the accrual accounting. You know what? The companies, the big companies can cheat through accrual accounting. How? When they find that their revenue is going down, what they do, they start selling their output not to any outsider, but to one department of the company is selling goods to the other department of the company. And they don't even sell. They don't even sell. They recognize it prematurely by using the accrual accounting. They can create a fake invoice that so-and-so department has ordered the output from us, and we are going to sell it in 6 months' time. This is the revenue, this is the cost, and this is our profit. Fake is the revenue, fake is the cost, and fake is the profit. So accrual accounting, on the one hand, is helping to connect the cost with the period to which it belongs, but at the same time, accrual accounting can be used as a ploy by the companies to inflate their revenues and deflate their costs. Or, so the accrual accounting is both a virtue and a vice in the hands of the corporate leaders. And they were also capitalizing their cost. Capitalizing is a word we use. Again, I want to add to your vocabulary. The capitalization is that there are some assets whose benefits will not come for 1 year, but for many years. For example, I gave you the example. You have a company, you buy a company car. You don't expense it straight away. You bought it for 40,000. Tell me, you will never show expense 40,000 for 1 year. Because this is a capital asset. Capital means the benefits will come for many, many, many years. So what you do then? You calculate its working life. Let's say 5 years. And you don't show 40,000, even though your cash has gone down by 40,000 when you buy the car, but in your records, you don't show expense 40,000. You show only 8,000 for 1 year, 8,000 next year, 8,000 third year. And because you have capitalized the asset. The company was also capitalizing its assets, which it shouldn't be. If you buy, for example, if you buy a monitor, even that was getting capitalized. Why? Because then by capitalizing, you would show less expense because your expense would be scattered for many years. And when your expense is less, your profit is more. So company was using all these accruals and capitalization techniques to artificially push the profits up. And then, by the way, Arthur Andersen again, you can call it coincidence. The auditor of this company was also Arthur Andersen. Oh. Yeah, so. And this was the final finding of the investigative committee after this whole failure took place. The board and the audit committee were given information that was both false and plausible. Plausible means based, just expected, not real. Audit committee members do not appear to have been sufficiently familiar and involved with the company's internal financial workings, the weaknesses in the company's internal control structure, or with its culture. The board of directors and the committee members were absolutely clueless To gain the knowledge necessary to function effectively would have required a very substantial amount of energy, expertise by at least some of its members and time, certainly more than 3 to 5 hours a year. They were not spending more than 3 to 5 hours per year in the company's matters. We are studying a course and we spend 3 hours per week. They were running multi-billion dollars worth a company, and those top leaders of the company, they were spending on an average less than 3 to 5 hours. Max, they were spending 3 to 5 hours a year to run the company. This is a shame. Yeah. How can you run a company by giving only 3 to 5 hours a year? What would you do in those 3 to 5 hours? So is the sorry state of affairs of the, the corporate culture. And then there was corporate greed. Abers, the WorldCom CEO, he wanted to write his name in the history books. As a CEO, he should have been committed to work for WorldCom, because how on earth a CEO can get so much time besides his personal life that you can also uh, be a board member of some hotels, real estate ventures, cattle ranch, timberland, rice farm, luxury yacht building, and so on, and even having a hockey team and spending too much time. I think he spent more time with the hockey team than with the company. Okay, this is the typical agency cost, that how much are you giving time in proportion to the money you get from the company. Okay. Abers was on mission acquisitions so that he could make WorldCom a monopolist, but most of the money he was getting from the loans, basically. And the loan was secured by his personal stock. But when the stock value was going down, the bank called him. Hey, it's like, for example, imagine I take a loan of 100,000 euros. I give you an example. And I have a property which I give as a security, and this is also 100,000 euros. If the price of my security goes down, will the bank call me? Imagine you buy a small studio apartment in Uvascular, and you buy it for, let's say, 60,000. When you get the loan, the bank, before you get it, the bank will say, can you give some security? And you ask your parents or friends or whosoever, because you were not having it, and you arrange your security, and that the value of the security is, let's say, 50,000. The loan is given to you, you bought your apartment. After a few months, bank call you and say, you know what? The value of the security that you gave us has gone down. Give us more security, or if you don't pay us, we will take away apartment from you. The banks can do it. The same thing happened to Abers. He took loan with his stocks, the shares which he could get from the company, but the stock price went down, and now the banks are asking, give us more security. And guess what he's doing? He is getting loan transferred from his personal account to the company's account. So the loan which he was taking was transferred to the company's accounts. Means the company would be liable to pay, not he himself. So the personal loan was transferred to the business loan, including the interest, and all the burden he transferred to the companies, and he just walk away free. And when the company got bankrupt, the loans and the guarantees which Evers took was more than $400 million, which he absolutely moved to the company accounts and he just walked freely. This was a classic case of when there's an absolute, when you are powerful, as they say, the absolute power corrupts and the power corrupts and the absolute power corrupts absolutely. Nobody was challenging. That's a problem. That's a problem. Whenever we see the names of the companies, the big brands, there's some big people, the big names. And sometimes we wonder who's bigger, the company or the man or the woman who runs the company? Who's big? Who's more important? The problem is that there's too much importance in the personal capacity. Sometimes it backfires because when you become too important, you become too indispensable, you are almost irreplaceable, you're almost immortal. Then these people can do whatever they want and they almost go unchallenged. This happens in the small companies. This definitely happens in the big companies. Yeah. The third case, but before we go to third case, let's take a break. Yeah. And let's meet in 20 minutes. Okay, so we resume the recording now and we on after the break. So yeah. So the third big scandal or the big corporate scam that took place recently is by the General Motors. I would like to mention that today we will see, or we have seen, or let's say we have seen two cases, Enron and WorldCom. These companies do not exist anymore. The fourth one is Northern Rock Bank, which doesn't exist anymore. GM is the only company which went through this turmoil and it still exists. So therefore, out of four scandals that we are discussing today, this is the only company which still survives. The biggest auto giant in US, or one of the biggest in the world, GM, it has to pay $1 million penalty to the Securities and Exchange Commission. And just once again, I recall the Securities and Exchange Commission is the ombudsman, is the apex authority of financial activities in the USA. It's the biggest regulator in the world, I can say so. And it's very powerful. Okay. So the SEC imposed a fine on the GM equal to approximately $1 billion. And the reason is that there was a failure in its internal accounting control, which did not recognize one thing. Whenever a company is publishing its annual report, it must publish its risk factors. And while with the other examples, with the other companies, because those companies don't exist anymore, I showed you the example of British Petroleum, right? But for this company, because this company exists now, I must show that have they improved upon anything? What they didn't do. Why were they penalized? They were penalized because the company's accounts, the company's report did not include the likelihood of, because whenever a company publishes its reports, it must publish what are the risk factors which can potentially harm it. And one of them is any potential recall because of any technological failure. And one big failure happened to the General Motor was that there was a defective ignition system, which not only caused the problem to the car as such, but it also posed risk to the passengers as well, the life risk as well. So there was an absolute failure and they didn't record it. Well, how do they know it would happen? But okay, the company didn't know that the ignition system can fail. But the company must know that because of some technological breakdown, it might have to recall the cars. The same thing happened after a few years in case of Volkswagen as well. They didn't record it as well. So instead of two cases, I'm just discussing one because they are quite similar. Okay, but now out of curiosity, I went to the General Motors website, and I saw that they have given now more detailed risk factors. Okay, and one of the risk factors is on page 20 because I just put the keyword recall, and I found that on page 20, yeah, on page 20, there is it 20? Yeah, here, 21. They now clearly say that maybe the previous one, or this one here, 20, yeah. Yeah, now they are saying this is what they were supposed to do and they didn't do. And as a result, the SEC hold them accountable for non-disclosure of information. So they are hiding a risk factor. A customer of GM, General Motor Car, must be aware that the company has published the potential risk factors. Okay, and now they are writing it down. Alleged violation of fuel economy or vehicle emission standards could result in legal proceedings, the recall of one or more of its products. Here they are saying it. Now they're saying they didn't write one sentence back then in 2013. And guess what happened? They were slapped with almost $1 million worth the penalty that they are hiding a material fact from its stakeholders and, of course, the customer. The customer should be aware that in case there's a technological breakdown, the company has to recall those cars and they get some, compensation in lieu of that. Okay. The regulator says that the manufacturers, accountants were not made aware of the company's internal investigation. They didn't make it clear and they didn't publish it. And as a result, the penalty was paid. And the lawmaker was even more angry because there were some accidents. And there have been about nearly 124 people who died, and there were about 275 people who got injured because of this defective ignition system, and it was not recognized as a potential risk by the company. It's an risk factor. Remember, whenever you open the company's annual report, this is why sometimes students ask me, Shab, should we get the data from third-party website like Yahoo Finance or something else? Okay, I say that if it's only a matter of numbers, you can take whichever source you want, but it's a good idea that you also come across the company's original actual annual report, because then you know that how the report looks like. I mean, if you look at the report, let me show you BP. There's a full proper chapterization. When you open the annual report, you see for example, there's a contents page. And in the contents page, you can read the company's strategy. I don't like that people get my lectures free of cost. We can pay for it. Come on. So we have, for example, this BP. There is a strategy report. There's a letter by the chair, chief executives, company's energy outlook, strategy, performance, business model, which is very important. Business model is my future research area. I think in a year or so, when next year, not you guys, when the new batch come, I think when those people who choose finance track, then I would be having a focus area of financial business modeling part. So the business model is very important here, okay? Then there are risk factors. So that is why I don't push you, but I give a mild bias that, you know what, you should get the data from the original report, because then you know so many things about the company culture, basically. So in the risk factor section, and now you can see that the General Motors, GM, they also have their annual report, of course they do. And they now have the risk factors. Well, they used to have at that time also, but this information, which I just showed you, that they recognize that the recall can take place, this was missing. And because this information was missing, the SEC call it misleading, omitting the fact, uninforming the investors and the customers. And as a result, what happened? It was an unlucky year, 2013-14 for GM, and several accidents took place. And the investigation showed that the main reason behind those casualties was the faulty ignition system. And as a result, several cars were recalled, and there was a very big fine imposed on General Motors. Okay, the company paid to the Justice Department, and it also set aside $1.1 billion to meet the lawsuits and to pay the compensation to those people who are affected by this. Okay, so this is you can say that it's nothing in comparison to Enron and WorldCom. But what I'm trying to say, you remember I told you beforehand that there are two types of things which companies can commit. One is commission when they do something, and one is omission when they deliberately don't do something. This was a case of error or a omission. They did the omission of information, and see how much penalty they have to pay. So the regulators are very strict. Remember it. The last case of corporate scandal today is the Northern Rock. One more difference. The first three cases were of the USA, right? And the Northern Rock is a case of Britain, right? The Northern Rock, a very famous bank. Basically, it was more like a mortgage bank, which gives you the housing loans, particularly. Of course, you can open a saving bank account, no problem. But this bank was more specialized into housing finance. The Northern Rock was a UK-based mortgage in Newcastle upon Tyne area, which is a very happening area. I've been there so many times. It's a wonderful place, Newcastle. I mean, yeah, it's a very good shopping area. Yeah, I mean, you get excellent brands. Nowhere else, maybe even in Britain, the kind of brands you can get from Newcastle. This bank was ultimately nationalized by the UK government in 2008 after experiencing a run by savers. You know the run by savers? A run by saver is that, imagine you all have a bank account in a bank. I will not name it, even in the example. And imagine there's a rumor that this bank is going to collapse in few hours. The bank has already collapsed. What would you do? And you try to do something on the, how to say, in your e-bank, but now the server is dead, or is busy. What would you do out of panic? You come to know, it's a rumor, I don't know. You come to know that the bank is going to collapse, or the bank has almost collapsed, or the bank is closing, finishing, no more bank. What would be your reaction? And you have your deposit with the bank. You have your savings with the bank. What would you do? Any guesses? You will withdraw, you will run. There'll be queues outside AGM, and there'll be queue outside the bank office, and they would be banging doors. Open the door. We want our money back. Yeah. This phenomenon is called a run by savers or run for money. So that's why I put in italics. So what happened is that there was a run by the savers, and suddenly there's a panic. Remember, I think I shared with you, if some cake making company, or if some automobile company, or if some furniture manufacturing company, if they collapse, it's a bad thing. There are consequences. But those consequences are not as grim as if a bank fails. Bank are the sign of trust in the system. I mean, a furniture manufacturing company can fail. At the most, you might not get the after-sale services of your tables and chairs. But when a bank collapses, it's a very big question mark on the financial integrity of the country. It put a question mark on the regulator, on the government, on the state. And by the way, the banks are borrower of each other. If X bank fails, suddenly the savers are running for bank Y, bank Z, and so on and so forth. And as a result, a panic can trigger the actual banking crisis. So therefore, the government are super sensitive. Even if the banks are in the private sector, they have to work so much under the scrutiny of the state, of the government. So when the state of Britain, UK, found that there's a run by the savers on Northern Rock, they asked that we need to nationalize it. Nationalization means the bank is now owned by the state. Now the investors, the depositor can breathe because they know that they will get the money back from the state. The state would give them the money back because state will not run away. Oh. Once again, heavily reliant on short-term wholesale funding. The bank was giving not long-term loan, but for the short-term loan. And it was giving the loans faster than any other bank. The idea was that the bank tried to understand why bank was on giving loans, and the bank was given loan even for the subprime. I mean, anybody will come, anybody can come and get the loan from Northern Rock. You know why? Because the bank was saying, hey, you are my customers, take loan, give me interest. With the interest, our revenue will increase. When we have more revenue, our dependence on the state would decline. And then after 1 year in the meeting with the state, we would raise our hand and say, you know what? We are a self-reliant bank. The company was feeling pressure to prove something. The proof was that we earn so much money that we don't need any resources of the state. And we want to be declared number one bank in terms of its clients, its customer, and also in the revenue generation. This was a self-imposed pressure which the bank invited on itself, even though there was no need for it. There was absolutely no need for it. But because the bank's management, they were on mission proving something, that we want to prove the whole country that a small private bank can be self-financed, self-dependence, and self-sustained. We don't need any state's support. And as a process, they were giving loans to anybody and everybody, assuming that they will not default. Right? That is called subprime lending. The subprime lending is that I am giving, as a banker, I'm giving loan to even those people and the companies whose credit rating is very poor. That is called subprime lending, that I'm not keeping into consideration your repayment capacity. I assume that everything will be good, no problem, take loan. I trust you. I know you'll pay me back. It doesn't happen like that, you know. And they did this thing when the housing market was booming. The housing market was really going good. So they didn't want to lose the customer. Why? Because when the market is, I think I told you before many times today that the companies make mistakes when they are at the peak of success. They made a mistake when the housing market was going up and there were customers waiting for approval of loan. And then the middle management is pushing, jostling the senior management. Guys, why don't you approve the loan? These people are waiting in the queue. And the top management say, guys, we are checking their credit worthiness. Are they good or bad? And then they say, hey, make it fast. Why are you taking so long time? If you don't give them loan, then they will move to the other bank and their revenue will go up. And then the top management is pressurized to sign the loans even to those customers who do not even fulfill the criteria of uh, their eligibility test, if they are eligible to take a loan or not. So under strong market pressure, the Northern Rock was giving loans to even those clients, customers who didn't even deserve to be given loans. And as a result, the bank's liabilities went up, the assets value was going down, the liabilities were going up. And remember, by the way, the assets were going down because certainly bank realized that people who owe to the bank, they're not returning the money. But Northern Rock took loan from the other banks also. And those other banks were demanding their money back. So what I'm trying to say is that the company's liabilities were standing, but the assets value was going down because all the mortgages which the customers gave, their value was going down because the housing market was going down. And many of the clients slash customers, they were unable to pay back the loan because they were bad borrowers in the first place. They should not have been given even the loan at the beginning, but they were given. And now because the market was shrinking, and remember 2007 was a year when the major business slash economic slash financial crisis came up. 2007 crisis. It lasted until 2013 or something. 5, 6, 7 years of the global recession. So obviously, when you are having recession, people are losing jobs. How would they pay back for the mortgage? So many people, they just gave up, and many houses in Britain were empty uh, because the owners disappeared. They were not able to pay back the loan, and those houses, those apartments were taken over by the banks. But what would they do with that? Nothing. So it was not a very bad, and it was not a very wise move by the top management of Northern Rock. The bank was split into two parts. That part of the bank which was having more assets than liabilities, that was taken over. That was bought by Virgin Money. Virgin is a very big group in Britain. They've got Virgin Trains and so on and so forth. Very, the top super powerful corporate conglomerate. They took over the good parts section, but where the bad bank, where the liabilities were way more than the assets, that was taken over by the state of United Kingdom, because they said that, okay, we would do the restructuring. And there were so many announcements given by the politicians, the Bank of England, to the common depositors, please don't panic. Your deposits are secure. We will give the money back to you. Okay. Banks, the states can do it because they have more financial resources to pay to its depositors. Okay. And they also have a printing press. Hmm? You know why I mentioned the word printing press? If nothing works, they can print more money. Imagine I'm a private entity and I owe you the money. I don't have. You'll be in panic. I'll be under pressure. I have to borrow. I have to do whatever. But if I'm the state, if my internal resources are not enough, okay, to meet this contingency, at least I have one solution. And that solution is that I can print money and give it to you. You can have, the fresh money, the fresh from the oven. You can smell, oh, it smells fresh because it just got printed. Okay, so the bad part of the bank was taken over by the state. Yeah. The Northern Rock tells us one story, that when you are investing in the short term things, that can backfire. You should always, the loans, if you are having long term loans to finance short term investment, it still works. But if you have short term loans to finance short term investments, it's dangerous, because you are living very dangerously. There's a thin line this way or that way. So there's a very slippery slope. And it happens in the countries also, by the way. I'm not sure I gave the example or not, but 97 was a very bad year for the Southeast Asian countries. Southeast Asian countries means that includes Singapore, Malaysia, Thailand, Hong Kong, South Korea, including Philippines, Indonesia. Yeah. What happened? Those countries were called Asian tigers, many of them, Thailand as well. These countries collectively are called Asian tigers because of their very high growth rate. They got independence in 1960s, most of them, and suddenly the growth rate was so high. And the one reason of these countries' high increase of growth was that their financial system was very liberal. Very liberal. And then there was a gentleman, George Soros. Do you know him? He's a great investor, a very rich man. And on top of that, he's also a philanthropist. He runs charities, he runs NGOs, and he spends a lot of money on scholarships of students in developing countries. I mean, getting George Soros scholarship is a every student's dream in many Asian, African, and Latin American countries. He can finance your full studies up to PhD level in Harvard, Oxford, Yale, UCLA, and whatnot. What he did, now we see not his philanthropist side, but the investment side. He deposited money in these countries' banks. And that deposit was a short-term deposit. You know the meaning of short-term deposit? The current deposits. And what's the definition of current in finance? Less than a year. In other words, he could take money away anytime before 1 year is over. Whereas if you have a non-current deposit, then you know that money would never leave at least before 1 year, because we have 365 days, 64 days cutoff limit. But the short period, the current period, is from now up to 364 days. George Soros was flooding the money of these banks with his money. These banks were so happy with George Soros. And you know what? When you get more foreign exchange, the value of your country's domestic currency goes up. Singaporean dollar, Malaysian ringgit, Indonesian rupiah, the value was increasing a lot, and those countries were so happy. One day, in the morning, the news spread that George Soros have taken his money away offshore last night. The banks in these countries were empty. People were running for the money, the run on the banks. Since the money left, the value of these countries' currencies dropped like anything. There was a massive financial crisis. in these countries. Same thing happened with the Northern Rock. They were giving too much of short-term loans to the people, to the companies, and it was coming from the short-term loan which bank was taking from the other banks. Had the bank was taking long-term loan to finance short-term loans, the clients, they could have survived. But out of greed, out of market pressure, out of pressure to prove something, they did the opposite. And as a result, the bank was in a full-fledged fiasco. So much so, the state has to nationalize the bank. Okay, it was partly acquired by Virgin Group, and it was partly, restructured by the state. Why did they fail? They had a very faulty business model. They were trying to finance their short-term loans with their short-term borrowings in turn, which didn't work. The housing market went down during 2007 because first it went down in the USA, and then there was a trickle-down effect in the rest of the world, Britain, and then there was a lack of diversification. The company was only focusing on the mortgage loan, and mortgage loan. Banks also do many diversified activities like insurance, like consultancy, and like many other things. This bank was only relying on subprime loans. First of all, these loans were not even well deserving. They were subprime. Subprime means that the credit check was not done thoroughly. Bad loans, I can call them, with a poor credit rating, and and even so much so that they allowed their clients to have the interest-only mortgage. So, for example, if I'm a bank, you borrow from me, let's say 100,000 pounds, and I say, hey, don't worry. For the next 5 years, don't return any money back to me. Just pay me interest rate. That's it. So the actual money you borrow, you pay me. You start paying after 5th year, 6th year, 7th year. Don't worry about that. But until then, if you only pay me interest, I'm happy. That was a big mistake by Northern Rock. Okay, so because of these reasons, the system went down, and Northern Rock was in trouble. Luckily, because it was in the banking sector, and the states are very sensitive to the banking sector, and the people who had money, they were saved. If Northern Rock was not a bank, if it was any non-banking company making petrochemical manufacturing, furniture, blah, 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 maybe these investors would have lost everything, thanks to the fact that the state took control over it. Yeah. So these are the 4 examples of the major corporate failures. Okay. If you ask me, Shab, what lesson we have learned from these failures, I would say nothing significant. I may sound a bit pessimist, but I would say nothing significant. We have done some rules, regulation, reformation, not proactively, but as a reaction to these scandals. But people who commit these scandals or scams, they are way more intelligent than people who are reacting. Okay. There's still many ways you can dodge the regulations. So if you ask me, has something changed? I would say something has changed, definitely. But the what has not changed is very, very significant part. Okay, and a lot has not changed. And if it has changed, there's so many limitations. It's so wafer thin, those changes, that you can make your loophole very easily. It's not a big, problem to. If you're a smart guy, you can make your inroads. Okay, so these are the 4 examples of the major corporate failures. I have recorded it. Okay, I would strongly recommend you that when the recording is ready, do watch it. The many words, many phrases I used today, you might not be familiar with that. So bring to my attention, or at least we have some discussion in the discussion forum, so that we discuss something about these scandals, scams, embezzlements, malpractices, corruption, and whatnot. Okay. So thank you very much for your attention. Okay. So